Hi everyone, today our group is going to be presenting process accounting at McDonald's. Our presentation will cover several areas. In the next minutes, I'm going to be focusing on value chain and process accounting. McDonald's is one of the largest and most recognizable food service companies in the world. It operates more than 35,000 restaurants across over 100 countries, serving roughly 70 million customers every day. This massive scale means that McDonald's must maintain extremely efficient operations while ensuring consistent quality control across all locations. The company runs on a three-legged structure, including its suppliers, its franchisees, and its corporate management. Each of these legs plays a critical role. Suppliers provide standardized, high-quality ingredients, franchisees operate the restaurants, and corporate sets operational guidelines, quality standards, and strategic direction. Because about 95% of McDonald's restaurants are franchised, most of the company's income doesn't come from actually selling burgers, but it comes from franchising fees and real estate rent, which makes controlling operational costs across the whole system even more essential. The objective of management accounting at McDonald's is not simply to record costs, but to use cost information to guide decisions like pricing, menu design, and process efficiency. As Kaplan and Johnson in 1987 highlight, management accounting evolved to link cost information with real operational control. McDonald's is a strong example of this. It relies on detailed, standardized cost tracking to ensure every restaurant from Paris to Sao Paulo can produce the same Big Mac at a predictable cost and profit margin. Value chain and process accounting. Because McDonald's products such as fries, burgers, and drinks are produced in such large continuous volumes, process costing is the most suitable method. It allows McDonald's to calculate an average cost per unit across huge batches of standardized items, which is essential for consistent pricing and quality globally. The value chain shown on this slide has four main stages, including inputs, processing, distribution, and retail. And at every stage, McDonald's accumulates direct materials, direct labor, and manufacturing overhead, which creates a fully traceable cost structure that allows the company to monitor where resources are used and where inefficiencies may occur. For example, Lamb Weston supplies fries and tracks costs all the way from farms to distribution. These costs, like transportation and storage, are absorbed into overhead and applied consistently across restaurants. Another example from this slide shows how McDonald's saved 472 million kilowatt hours of energy between 2010 and 2014 by improving kitchen processes, which is an illustration of how process accounting supports cost reduction and operational sustainability. In theory, process costing assumes an average cost per unit, as Drury and Taylor explain. McDonald's uses this approach to ensure that no matter where you order a Big Mac, its cost structure and margin remain predictable, allowing for stable pricing and efficient operations worldwide.
McDonald's uses a normal costing system, meaning it applies budgeted overhead rates instead of waiting for actual costs. So this avoids seasonal fluctuations and helps keeps the meal costs stable and comparable across thousands of restaurants. So overheads are divided into production costs, centers like kitchen operations and service cost centers, such as maintenance, and staff training. To understand where resources are being consumed, McDonald's focuses on key cost drivers, which are labor hours, the numbers of meals served, and energy consumption, and packaging and waste level. Tracking these drivers allows the company to benchmark restaurants using standardized matrix. So overall, this costing system supports fair overhead allocation and ensures a stable, predictable cost per meal across the brand. Good. Here's how normal costing works in practice. So suppose McDonald's restaurants budgets it's a 1.8 million euros in overheads for the year and expects an 150,000 labor hours. Using the normal costing formula, the overhead rate becomes 12 euros per hour. This 12 euro rate is applied to meals based on labor hours and covers indirect costs such as rent, utilities, and maintenance. Using this method helps McDonald's maintain a consistent pricing and compare performance reliably across all its restaurants. McDonald's also uses departmental cost centers such as production cost centers for the kitchen operations and service cost centers for logistics, training, and equipment services. And using multiple cost centers improves accuracy because overheads are allocated based on a clear cause and effect relationship. Cost drivers are valuable when they're used to improve efficiency. They reveal where resources are actually consumed, for example, in labor hours, energy use, or packaging waste. Using standardized overhead rates allows McDonald's to compare store performance fairly, whether the restaurant is in London or Tokyo. So, for instance, tracking fryer energy use or drive through labor hours can identify bottlenecks and show where process improvements are needed. McDonald's also uses real time dashboards to monitor labor, energy consumption, and waste, helping managers react quickly and optimize daily operations. And ultimately, leveraging cost drivers strengthens the value chain's efficiency by supporting consistent product quality, stable profits, and better operational control, aligning with Capelin and Jocelyn's view of management accounting, linking cost information to performance control.
Now we'll try to understand how McDonald's uses cost accounting in order to know what to sell, how to price it, and how to design the process that will make the whole system efficient. First, we need to know that McDonald's uses what we call a product mix strategy that is driven by contribution margin and not by customer preferences alone. In fact, here what really matters is how much profit the item generates relatively to its preparation time. In fact, they try to promote high contribution products like soft drinks, fries, because they are really cheap to make. However, even though they seem more appealing in a marketing perspectives, other items like salads, wrap, signature burgers are really expensive to make since they destroy operational efficiency. So that's why here the focus isn't profit per item, but rather profit per customer served, which increases when the menu stays simple and when we focus on high contribution margin product. The pricing follows the same logic. In this case, McDonald's uses what we call market-based pricing and a cost-plus logic, making sure that the franchise cover food costs, rent, labor, and franchising fees. So the price of each order need to absorb at least a certain amount of fixed and variable cost. Additionally, they also use target costing before launching a new product. They try to set the target price, make sure that it covers the desired margin, and then they try to see if that's aligned with the cost structure. That's why we don't really see complex and premium products in McDonald's because, well, they don't fit the cost structure in this case. And also value menu, bundle pricing, and psychological pricing are also designed in order to increase the average ticket sale while trying to keep a cost per minute of labor really low. Now let's talk about design decisions. Menu design directly impacts kitchen design. In this case, McDonald's try to have a standardized preparation method that will make sure that every restaurant works the same way. In fact, removing complex items from the menu doesn't only simplify the menu itself, but it also reduces what we call non-value added time. In fact, in cost accounting terms here, we try to reduce the number of touch points per order, which in this case will help us lower the labor hours needed per meal. So this increases throughputs and perfectly aligns with McDonald's goal, which is to have extremely high regularity and speed. So in this case, design decisions are cost decisions. Brings us to systematic cost management, which is one of McDonald's biggest strengths. In fact, because everything is standardized, they have the ability to predict unit cost across approximately 40,000 restaurants. In fact, since they have centralized purchasing as well as long-term supply partnership, this reduces procurement and logistic costs, but also because every task is simplified, labor becomes faster and easier to train. Thus, reduces payroll, which is again one of McDonald's highest cost driver. Another key point is that the standardized cost driver, like labor hours or meal served, allow corporate to benchmark any efficiencies that there is in any restaurants or any franchise. So that's a perfect example of how accounting information supports operational control. Of course, this system isn't perfect. Overstandardization, for example, can be a challenge for innovation. Franchises can't experiment with local product even if there is demand. Also, we need to take into account that there is performance variation. In this case, even though procedures are the same, operators differ from one restaurant to another, which can affect labor cost. But also we need to take into account that depending so strongly on global supply chain exposes McDonald's to possible shortage and price volatility,
as products like beef or lettuce or potato. And finally, we also need to take into account that the rigid kitchen layout also means high fixed costs.
So now let's look at more the social and environmental issues that McDonald's faces, mainly due to its scale. In 2019 alone, it purchased around $1.9 billion worth of beef, contributing to around 53 million metric tons of greenhouse gas emission, with beef being its main major driver due to methane emissions. So, what is currently McDonald's doing to address these impacts? So, more on the environmental side, McDonald's has made more measurable progress, where in 2024, 77% of beef from high risk regions such as Brazil and Argentina were verified as deforestation free. And then 96.6 of its coffee is now sustainably certified, and more than 90% of its guest packaging is renewable, recycled, or certified. It has also launched 6 virtual power purchase agreements, renewable projects, helping cut energy related emissions, and also reduce virgin fossil fuel plastics and Happy Meal toys by over 80% compared to 2018. Then on the social side, McDonald's has achieved gender parity in its kitchens and has supported over 10,500 graduates through the Artways Opportunity Program. So now let's see this in cost accounting terms. So McDonald's is using SEG metric functions as non-financial performance. This is seen through their emissions, energy efficiency, and sustainability sourcing. No longer are they seeing sustainability as something to comply with, but rather as a long term business resilience and ability to maintain future supply stability. So, therefore, they're treating this as strategic investment. So, therefore, yes, they're transitioning to renewable energy, but that requires a lot of capital, and as well with their deforestation free beef initiative that also requires long term investments. Therefore, now they're seeing environmental costs as capitalized into long term investment centers.
To wrap up, our analysis shows that McDonald's relies on management accounting to keep its massive global system efficient, consistent, and profitable. Process costing and standardized operations ensure identical quality across more than 35,000 restaurants, while normal costing and clear cost drivers help control overheads and compare performance fairly. Contribution margin then guides product mix and pricing, allowing McDonald's to prioritize high margin, fast prep items. At the same time, systematic cost management supports franchisees with predictable structures, and ESG metrics show how sustainability now treated as a long-term investment. Overall, McDonald's demonstrates how accounting informs smarter decisions across the entire value chain.